Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To get even more content from me and Andrew, sign up for the Focus Compounding app. The Focus Compounding app costs $7.95 a month. It comes with a bunch of 2,000-word articles from me each week, a fresh batch of 5-minute videos from the both of us, along with one bonus extra-long episode of the podcast each Saturday, and immediate access to our complete backlog of 200-plus episodes. To sign up, go to focuscompounding.com/app or wherever apps are sold. And now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding. Hope everyone's having a great day. See you next to Geoff Gannon. Jeff, how's it going today?
It's going bro, Andrew. How's it going with you?
It's going great. Hope it's going great for everybody else. We are going to be doing a Q&A in this podcast. If you want to be on the lookout for future Q&As, follow me on Twitter at Focus Compound. That is where occasionally, about once a week, I will do a call for questions, and then we will answer them on the podcast like we're about to do right now. First question comes from Trey Henninger. He's been on the podcast, and you've been on his. He has his own podcast.
Yes.
It says, when will Naco stock bounce back above $40 per share?
No idea.
I'm surprised you asked that. Trey, is that like, he knows, he probably knew that would be your answer.
Yeah.
Will an investor that holds Naco until 2030 without selling do well?
It's a very good question, and I don't know the answer to that. I've thought about that. It depends on how well they change their how well they do their capital allocation and stuff. But that's a very long time to own it for 10 years. Obviously, if you have a cheap stock like that, but they're going to have at that point reallocated many times the free cash flow that they have in a given year. If we just average out what the free cash flow is now and what the market cap is and stuff, you'll have reallocated more than 100% of your today's market cap. Then I don't know if you have you can look up their market cap and everything. Oh, well, we could just look up their stock price because I know they have about 7 million shares equivalent on the A&B. So 150 million market cap. Yeah. All right. So Google did the math better than me.
I did that for my brother.
So yeah, 150 million. Let's say that the last 3 years or so, they average about 30 million in free cash flow a year. Without nat gas and stuff, who knows if they'll be able to do much of that, and they have the CapEx now. But in an average year, unless they lose their current business and don't pick up other business equal to it, then you're doing about 30 million a year. Means that you'll allocate basically 200% of your market cap. So this company is going to have to invest in new stuff, buy new stuff, whatever, in other businesses besides lignite, probably lime, lithium, whatever things they decide to go into, maybe buying nat gas properties, whatever. That will be 2 times the current market cap. So the simple answer is maybe. We know that I would guess that the price, that the book value will be a lot higher, and most of the book value will be stuff that isn't lignite. But otherwise, I don't know.
How do you allocate dividends in the coffee can portfolio? I thought this was a great question. And this is the gentleman that wrote about how he's changing his personal investing to the coffee can portfolio approach. So there you go.
I would just have the dividends go into a cash fund that you then use on other stuff.
There you go. So do not reinvest the dividends back into the stock.
No.
Pay it in cash.
I wouldn't. I wouldn't, because that becomes like, reinvesting in that stock over and over again. For some stocks, that could become very significant over time, and now you're buying at a totally different price. Yeah.
Tobacco stocks, is that a good value? Are they good value?
No. Tobacco stocks are not a good value. No, they're generally very expensive.
Got it.
Yeah.
AR-622 module containment rework project asked more questions like this other question. These are very well thought out questions.
Good.
Next question. What are yours and Jeff's long-term goals for the fund? A Schloss-style fund that lasts 50 years. Andrew, do you enjoy the marketing research side of this alone, or do you have the aspirations to one day run a fund by yourself? We both talked about individual long-term goals. Do they mesh?
Oh, wow.
And he says, I guess I'm just interested in the personal side of what you both do, and curious if you talked about how to mesh both of your long-term goals, or if you're taking it a year at a time. Love what you guys do, and your content has been a must-see so far.
So yeah, Andrew doesn't like this, that I joke all the time about, I'm like, until we hate each other and stuff, and don't do any of the, because I always mention whenever we're talking about any situation from people who work together and stuff in these books, these business biographies and stuff, I'm like, yeah, and then they had the, had the falling out and whatever from this point. So yeah. What?
Yeah, I do not like when you joke about that.
Yeah. Yeah. We've had many discussions about that sort of thing. We definitely have talked about how to do it longer term and what that takes and what kind of things to avoid and stuff, things that could be good and successful in the short run that can actually be damaging in the long run if you want to do these things forever. We do have to be focused on like keeping certain stress things down, for a long period of time. That can be, that can be hard. I mean, look, I think like aspiring to running a fund for 50 years is great. I also do point out to people that Buffett and Lynch both quit in like about 12 years, give or take a year.
Yeah, I was gonna say, you don't meet a lot of people that run a fund for 50 years.
And there's a reason why. If you read the history of, if you read what Buffett and Lynch were doing, they like burned out and stuff.
Yeah.
And then there's other cases where I talk to people all the time about certain funds and things and what went wrong with them. And a lot of times it has to do with what money, they're bringing in too much money too fast.
I've talked about that. I feel like a lot of people in the fund business, unfortunately, and again, I'm generalizing here. Maybe it's the people I read, small sample size, whatever, are forced out of the business.
Okay.
Right? Whether that's because of like stress, like you said, they're burnt out, or they're forced out because they perform incredibly well, they raise a ton of assets, and then their performance diminishes greatly.
Yeah.
And then it's just like, I don't know. I would hate the initial thought that people have of focused compounding, everything we do is, well, they had a really good run and then maybe their egos got to them, they got too big and then they grew too much and whatever. I mean, there's a lot of things that I think you have to realize. I mean, we talk about things all the time in certain situations where if we were running our own personal money, it would not be an issue at all.
Right.
But it's hard when you have investors and it's just certain things you just have to think about and set the right processes in place. And I think it's something that I think we've thought a lot about, even things of how do we not hate each other? How do we travel well together? You know, I mean, like you learn as you do certain things. So you don't want to rip each other's heads off and just have a good relationship and a working relationship and everything like that. That's all very important, right? If you want to do this for the next 50 years or whatever. And then, if you have success, how do you continue to pump out 5 podcasts a week or, or want to even do that or want to do anything public. I don't know, or continue to run capital. I mean, there's a lot of people that return money because they're like, I'll just do it myself. I feel like the fund business, and this is, again, is totally my opinion. I think it's a very hard business by yourself. I just really do. Okay. There's been a couple situations where it's been nice to have a partner to be there to talk things through in certain situations and who may know what you're going through or whatever. And not to mention, I mean, we do have a life too. So there's certain things that could happen in your life that could, that's just good to have a partner there or a business partner to, help you and, wants you to succeed. I mean, it's like, I want Geoff to succeed as much as I want myself to succeed because we both succeed and our fund to succeed and our partners to succeed. And I think the way we structure the fund is the greatest because of the performance fees that we have on the fund. We don't charge a management fee in the fund. Right. So it's, majority of investors are on 0 and 15% of the profits. And I think what that does is that incentivizes us to really be like a partnership. And I've felt like that there's been certain situations in the fund in the past couple of months where I told Geoff, I was like, I really feel like we have partners. I don't want like a client portfolio manager relationship. Combative. It's like, I want them, it's a partnership. Let's talk about it.
And we did that intentionally. But of course, most people can't do that. Because if you make the decision to just run a fund with nothing else, then you really can't charge just a management fee. Yeah, so like Buffett did and stuff, but Buffett already had some wealth that way and stuff. Go ahead.
I was just gonna say, so for people that make fun of us for charging subscriptions and stuff, it's like that's why we. I mean, yes, we pump out valuable content, but of course that's the reason why we're doing it. Because we want to make reoccurring money.
Right. We don't do subscriptions to make money over time. Like we don't expect to get rich from doing subscriptions. Yeah. We do subscriptions to things to make money each month so that we don't wait until the end of a year, even an up year for a fund to get any money. Yeah. Because we don't collect money during the year on the fund no matter what.
The fund is paid. I mean, full transparency. I mean, it's paid once a year. So that's pretty much it.
And you won't be up every year. Yeah. So, think about that. If you're up 8 out of 10 years, then you got paid 8 times in a decade, that kind of thing, which is great. And if it works out and stuff, then it's a good success that way. But of course, the average person can't just quit a job and just start doing it that way. You have to have it kind of set up some way. And we do that intentionally with like subscriptions and things like that meant to be a baseline of how two people can afford to live and stuff.
Yeah.
You know? And that's not how we don't plan to sell. We don't plan to use profits from a fund to be how we make, how we live day to day and stuff.
Yeah.
You know?
The fund, ideally just continue to.
It's a form of savings and stuff.
Roll it back in and generate wealth. But it's just, it's like, I just think it's interesting when sometimes I see people that talk about the fact that we, sell subscriptions or whatever. It's like, yeah, we do. We're in business. I mean, what do you want from me? You pay $8 for a cup of coffee. We charge $7.95 for the app, and we give out content. Like, sue me.
Well, that's also an interesting one about like the longevity thing.
Yeah.
We've made a decision.
And the reason why we do it is for longevity.
Yeah. We've made a decision basically not to do advertising in the middle of the podcast. So if Andrew or I were to, and it would be Andrew, to read an ad that's, some financial seminar thing or whatever in the middle of a podcast, the revenue from that is very, very high. It's especially very, very high based on the number of subscribers you have. Like on a per thousand basis is incredibly high for our kind of content of a show, because that's hard for people to reach that kind of audience in any kind of numbers. And a host read ad is just very effective and stuff, Okay. But why we prefer instead to have a lot of people on a subscription thing, in part because longevity and stuff. We rather have more of a connection with a smaller number of people paying for like a subscription of things and stuff that we do than to get it from advertising. And advertising is not a permanent relationship. And, COVID happens and then it goes away and everything. That is one of the things. We don't just do like, let's maximize revenue on stuff. We do like, let's try to figure out how you get stable amount of stuff over time in monthly income from things. Yeah. And so like when we have a member website, that doesn't plunge to nothing because there's a recession and COVID happened and stuff. But advertising can. And, a fund will have a year where it's not profitable at all, so no money comes in from it. So it is helpful to have some amount of things from that. And, and for most people, all you have to do is charge like a 1% management fee or something. And then with that would do it. Sure. But we wanted to do no management fee. And so we were able to do that by doing subscriptions and stuff.
But do I enjoy the marketing and research side of this alone? Yeah, I think I enjoy it. Obviously, we're doing a lot of marketing now. I think it's been good for getting our content out, and we've really built a firm stemming from a lot of that, a lot of me recycling a lot of Geoff's content. I think I'm good at getting the best out of Geoff, right? And taking a lot of your content and kind of pushing it out to the world. I do enjoy doing that. Okay. I do spend a lot of my time doing all that, but I also still look at stocks and all that sort of stuff as well, because I do enjoy that part as well. But yeah, I do enjoy it.
Are you going to answer the second part or avoid it?
What was the second part?
Aspirations. You can avoid it.
Do you have aspirations to? I don't actually. I don't think so. I mean, it's like, it's weird. Like it's you and me. Like I really do think this is I do think it would be a very challenging business by yourself. I just really do. I really think it would be. And the
history of this business and most businesses is that if two people are running something and it becomes successful that way, eventually someone thinks, well, what if I ran it myself too, though? Yeah. So instead of
at that point, I don't know. I mean, look, I clearly work with you because it's more than. I get a lot more out of it, is what I'm saying, than money. And that's, I guess, the bottom line. So
we'll see. But sure, eventually sometimes that happens for people that they're like, want to be more in the spotlight with the whatever thing. No. And we'll see. But that's happened before.
It has happened.
Yeah.
Well, how has Munger and Buffett had such a long career together?
That's a very good, a few things. Honestly, a very big part of it is Munger's basically says, I'm number two. Yeah. That's a very big reason for it. And then also they have the personalities where they don't fight over that and stuff. That's absolutely true.
Hey, but man, in your happy birthday tweet, I said, all I've tried to do is make your star shine. Help make your star shine bright.
Yeah. But you remember the Wild and Diamond biography thing?
Yeah, but those are, I think it's a little different. And that's like corporate America,
Yeah. But anyway, very different. But I just mean like as an example of that or something, there was some people there got offended by something that wasn't even the decision of the other person. It was just that like, they were writing an article and it wasn't all about one person. It was like, oh, but look at the angle they wanted to take on the article was Diamond as being like the secret behind Weil or whatever. And so, I
So
mean,
then Weil got pissed and
because
it's an ego, maybe.
because they don't tell you ahead of time media things when they do this. Of course, they never tell you what angle they're really going to take on a story till, they try to get access.
Turns out
and
to be a hit piece.
Yeah, exactly. But so things like that happen. So we'll see over time.
I mean, the incentives that you set from the beginning are very important as well.
That is
compensation stuff like that.
That's very true and stuff. And we basically do the same. Basically, Andrew and I have the same cuts of just about everything. Same cuts in the sense that we don't renegotiate each thing that we do. So you might be surprised that like something that's mostly done by me or mostly done by Andrew doesn't mean that we don't share revenue on that and stuff. If we did, then we'd be in fights all the time over that kind of stuff. Yeah. And we even talked about that before with partnering with someone else that we did on something. I was like, let's partner across the board because you never want something where in one channel you get like 50% of the revenue and the other you get 10 because someone will steer someone to the other thing, Yeah.
I was telling somebody actually the other day, I saw a tweet or whatever. Somebody was talking about somebody offered them like $300,000 for their Twitter account. And I was linking through, I'm like, okay, it's taking me like maybe probably like 2 years to kind of build this following. Whatever. I'm like, hypothetically, somebody offered me like, what number would I have to, be like, this is just stupid. You have to take it, right? If I could just go redo it all over again. And I was telling this person, I was like, okay, well, if it's, X, I'm like, I would, it'd be 50-50 Geoff and me. And they're like, you would, even though that's your Twitter account, you would still give him a half. I'm like, well, whatever percentage. I'm like, well, that's the way that we always do it. I'm like, and like a lot of stuff I use is his content too. I'm like, it's just clear across the board. I'm like, just like line in the sand. It just makes it cleaner. And I think, you talk about how not to hate each other long term. I just think from the beginning, if you set certain things up like that,
it'd be really tough if we were negotiating like each thing separately about it.
Like,
oh, I should get 70 and you should get 30 on this, and on this I should get 30 and you should get 70 because we're doing whatever, things like that.
Wow, what a great question. We've been talking a lot. We didn't even finish this thing. What did you say? I'm curious if you talked about how to mesh both of your long-term goals or if you're taking it a year at a time.
Both of those things are true.
Yeah. Okay. That was a great question. Do you think that 13F of Berkshire suggests that Warren Buffett anticipate a market correction, not because of bear gold, but the decrease of financials stocks in his portfolio?
Yeah, you talk a little with Vetla about that. I don't know. I mean, I have this possibility in my mind. I don't want to throw it out there as like a theory or whatever, that if he had all his choices of what to do, he would like to focus on buying a lot of Bank of America. Buffett would prefer to own a very large stake in Bank of America rather than in other things. Now, I don't know if that's all of his reasons for selling like he's done. For some of them, it makes some sense. Wells Fargo has some regulation and stuff that getting out of it would make sense because I think Bank of America is more attractive on that basis and he could buy more of it. But I just don't think he's going to like get out of Bank of America. I really think that I wouldn't be surprised if we see simultaneously sales of the smaller positions in financials getting out of them while concentrating in Bank of America. Sort of like I said, that I could see this possibility with sort of the way he did railroads, right? Where he bought all the railroads at first, and then really he focused on just Burlington Northern when he had the chance to buy it. So.
Next question says, suppose I go to Texas and in the hotel conference room see a very live-like hologram of Geoff. I conclude that Geoff is staying at this hotel. As luck would have it, Geoff is really staying at the hotel, but it has nothing to do with the hologram. Can I be said to know Geoff is staying at the hotel? He's very big on this like perception of reality.
Yeah. So I mean, to be honest, I mean, this is off topic for the podcast, but I'm philosophically ultra hardcore subjectivist in the sense that I don't believe in that this question is difficult from an objective perspective. That what you're doing is you're just viewing it from two sorts of things, from two different ways of people understanding what there is. And so you can't ever know objectively that I was or wasn't staying there, but we have two different perspectives on the same sort of thing. The same way that like if you imagine a black hole or something, right, there'd be you can't describe a black hole from what's happening at the black hole as from an observer a certain distance away from it. They will look like two different things. Does that mean that neither of those things are happening or you can't perceive it that way? It's just a perception of it. We don't have an objective. We can't talk about objective reality.
There's some like quantum physics stuff. Have you been watching Interstellar lately after I talked about
no,
it?
not actually
I
like
think
that.
you
Yeah.
did. I think you did. That was a great answer. When analyzing a stock, how to refer to convertible bonds, and will you invest in a company that dilutes shareholders on a regular basis by issuing such bonds? Isn't it the same as issuing stocks?
It's sort of the same as issuing stocks. I'd have to analyze it carefully because normally when I look at companies, I just figure out the drag that they would have from it. It could be not bad. I mean, I invested in Omnicom, which had the convertible bonds. Berkshire did convertible bonds at one time. It is possible for some very safe companies to get incredibly low interest rates if they issue convertible bonds. Obviously, it implies one of two things usually. One, it's hard to issue straight bonds. So you would do that because you're just having difficulty getting a reasonable rate. Or two, the people who own the stock think that the people who run the company think the stock isn't cheap. And like in the case of Omnicom and Berkshire, I think that's what the case was. Mm-hmm. So I don't blame them and stuff. They, say you had at the peak of 2000 or whatever in Omnicom, you had a chance to do a convertible bond that would give you a really, really low interest rate for a really long time. And it's not that dangerous a convertible because what if your stock's selling at 40 times or 50 times or whatever earnings? But it's a sign that your stock isn't cheap. Like if you issue a convertible smartly, you're taking the bet against your own stock, basically. Mm-hmm. So it's not really a good sign usually when you see a convertible that way.
Next question: when investing in overseas companies like the UK, Korea, etc., how do you deal with currency risk / fluctuations?
We don't. We basically buy. I mean, this is way off the topic of the sorts of things we normally talk about, but basically, we buy into a country in which I feel the currency is kind of cheap or whatever. So and then we expect to benefit from the currency over time. So we just look at it and we're like, oh, if the currency gets back to what I would think is an appropriate level over 5 or 10 years, maybe we'll earn a few more % from this. I think that's smarter than hedging. We don't hedge, but we'd have to hedge if we were going into a country where I thought it was overvalued. Instead, I try to make actually a little money on the currency too, which is speculative and, whatever.
Virtu has awful employee reviews from Glassdoor and great customer reviews. How can this disparity be explained?
Yeah.
And then you just ask why we chose to ignore the employee reviews when you
to be honest,
Virtu.
I mean, this is heartless. I'd rather a company have good customers than good employees. Yeah. I strongly prefer that companies be run to make their customers love them than to make their employees run them. There's someone talking about some stuff that Chick-fil-A does and whatever, and they're like, well, doesn't that annoy the employees or whatever? Yes. But it makes the customer have a better experience over time that way. I mean,
my pleasure.
My pleasure. It's good if you can do both. It's good if you can have better employee reviews and things and then as well as customer things. But if you're asking what would I rather, sometimes I'm worried when I get too good customer reviews. Too good employee reviews. I think some companies do too. I think it's very easy for a company to end up being captive to its employees. That you start running it to run things for employees. It makes everyone's life easier at the company. Mm-hmm. No one wants to be running a company where all the employees hate you.
Sure.
But it's easier to run a company where all the customers hate you because you actually 90% of the people in the company deal mostly with other employees. So it's easy to, deal with all that and all that friction and whatever and adopt those things. Compared to most people, I do have this thing that I care a little bit less about how happy employees are there. Not nothing. And I think, it depends on what the reviews are about.
You could get
I have noticed.
Insight.
I mean, I've read the employee reviews at Virtu and at other companies. So,
as a small private investor, how would you go about contacting management? For example, would you email investor relation questions, call right away, etc.?
You can try answering that. What would you do?
You could do a lot of different things. I would just do everything. Okay. Right? I think that's really
they have a contact person usually included on everything who's either an investor relations person or someone else. Yeah. If they're like an investor relations firm, I don't know that that's going to be that successful. But for some companies, it will be like a CFO or the person below them, like a vice president or something.
No, go ahead.
And so they may talk to you right away if you try to talk to them. I've had plenty of small companies where the person who The CFO or one level down from that is very willing to talk when there's an internal person who handles most of the investor relations stuff.
Let's see. Why is value underperforming? We'll only do a couple more. It's kind of going long.
Okay. I don't know why value is underperforming. From what I can tell, things that were performing well before COVID are performing well again, and things that weren't aren't. This was one that was baffling to me. Like a good example was I was looking. We own Virtue Motors, and I was looking at that, and I was looking at what was it? Like as an example, that, and then combining that with like home builders or something was a good one. And home builders have really done well since then and stuff. Whereas like the car companies haven't necessarily, regardless of what their results of the day, of what they report and stuff. And there's a few other ones like that I was looking at that surprised me in how much they've bounced back from that. I just like, this is the big example that will show you that it's like, it's hard for me to, who knows, to figure it out, right? So we own, this is a really good example. What's a stock that I sold and what's a stock that I've bought more of since, so like as COVID was happening and stuff, what did I sell and what did I buy more of? And I bought more of like Virtue and sold Points International. Well, we can measure this a bunch of different ways, right? But if you look at a chart, if we just use how far they each off their highs, okay, a company that sells airline miles and a company that sells cars, the airline miles one is about down the same as the cars one, which would shock me from the perspective that no one knew COVID would happen. So that's pretty impressive. I don't know what it means, but like if I told you there was going to be this pandemic and everything, you would swear that a company that just sells airline miles basically versus a company that just sells cars, of course you'd be much safer than the one just selling cars, right? Yeah. Well, they're both, now like over certain months and stuff, Points International is still down more and everything, but just, that's really surprising to me.
Do you believe there will be more airplanes in 2030 than today? How do you think the industry will change in the future?
Yes, I think there will be more airplanes in 2030 than today, and that's why I don't like the airlines. I mean, that's my big worry with the airlines. It's always been my big worry. That my big fear is, yes, I'm always afraid there'll be more airplanes than there need to be. Yeah.
For private investors, is it better to continue to learn as much as possible and wait to find the perfect opportunity before investing, or start investing even if they don't feel like they have everything they need in terms of investing knowledge?
Start investing, unfortunately. Start investing and lose money but gain experience, Yeah, I've never, like no one that I've known has been able to just not invest but learn a lot and then start investing and be great at it. You really learn a lot from those experiences that you have. Running your own money yourself. That's how you get all the experience of that's how you learn your own style. You have no idea what your style is just by reading.
Alcohol companies are great long-term compounders. Does Geoff have any insight on how the economics differ for the subcategories of that industry? Beer, wine, and spirits. It appears like spirits producers are by far the best businesses out there.
Yeah. So it's a little complicated because we're saying like producers and stuff. It's kind of like movies, like producers versus distributors versus whatever. They're usually the same companies, but in all cases they're not and stuff. Having the rights to distribute is pretty valuable too. But many times when we're talking about a company that you're saying is producing it, it's also the one distributing it. But, it would be spirits best, beer second, wine last. We've talked a little bit about that, but one of the really big reasons is we've talked about like the survivable niche kind of idea and stuff. It is much easier to have a subscale wine business survive and stay in the industry and stuff and be a problem for everybody else than it is from a subscale spirits company. In lots of different countries, there's a particular spirit that's a favorite of people and stuff in a way much bigger than wine. Things like that. Spirits is a winner takes all kind of business as compared to wine. Beer, same idea, but over time with, like we talked about with Boston beer and all that, it has all of these may not be as good businesses as they once were because for the leader, for the winner in them, because they're less winner take all than they used to be. But for a variety of reasons, I'd say spirits. The problem for the stocks, of course, is if you look at how cheap wine stocks are versus spirit stocks and stuff, But yeah, that's the order. It's spirits is best, then beer, and lastly wine.
Cool. Well, I want to thank everybody who asked us a question on the Focus Compounding podcast. Make sure you follow me on Twitter at Focus Compound if you want to be able to ask a question in the future. I want to thank everybody so much for tuning in with Geoff and I. Hit that subscribe button both on the podcast and on YouTube. and we will see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk general investing concepts. To get even more content from me and Geoff, sign up for the Focus Compounding app. The Focus Compounding app costs $7.95 a month. It comes with a bunch of 2,000-word articles from Geoff each week, a fresh batch of 5-minute videos from the both of us, along with one bonus extra long episode of the podcast each Saturday, and immediate access to our complete backlog of 200 plus episodes. To sign up, go to focuscompounding.com/app or wherever apps are sold. Thanks for listening, and we'll see you in the next podcast.